Welcome back to the Carbon Exposure Project, where we dive deep into the ideas, markets, and people shaping the future of climate finance. In this episode, we sit down with Scobie Mackay, co-founder of Imperative, a company taking an infrastructure-grade approach to nature-based carbon removals. Before launching Imperative, Scobie spent more than 15 years in structured finance at Macquarie, Standard Chartered, and Norton Rose. Experience he's now channeling into building a new generation of large-scale, investable carbon projects. Imperative's mission is to professionalize the development of nature-based projects, restoring native forests and mangroves, while applying the same governance, risk management, and project controls you'd expect from a billion-dollar infrastructure build. We unpack how this approach could redefine what quality means in carbon markets, from delivery and reputational risks to the rise of developer-led insurance and the need to finally price the risk of inaction. We also explore how long-term offtakes, maturing derivatives, and biodiversity premiums are shaping the next phase of carbon finance. Welcome to the Carbon Exposure Project.
Scobie, mate, thank you for coming on the Carbon Exposure Project. It's long overdue, and it's a real pleasure to see you again, man.
Yeah, thank you for having me. Great to be here.
Yeah,
really, real pleasure.
Cool, man. We've known each other for quite a while. I've had the pleasure of working with you in your former role at Macquarie, and now really looking forward to collaborating with you and your team at Imperative. I'm really excited for our conversation because your team and your mission is really interesting to me, and I think it'll be to our audience in terms of the ambition that you guys have to radically improve, I won't say transform, but to really improve this market by helping to unlock carbon removals at scale. And it's that emphasis on scale. So I really want to dive into that conversation with you today. Maybe we can just take it back. Can we get your origin story? I've known you obviously for a while, but I think it'd be really beneficial for our audience to get to know who Scobie Mackay is.
Yeah, sure, absolutely. So without making it too long and boring, my parents were hippies from the hinterland behind Byron Bay in Australia.
Mm-hmm.
People who know that area, that was a hippie refuge back in the 60s and 70s, and my parents were not placid hippies; they were activist hippies, and they were active in really trying to protect the ecosystem around that area,
mm-hmm.
which has some pretty amazing native rainforest.
Yep.
And so that was the context. My dad had a PhD in biology. And I always assumed that I would be a scientist or a biologist myself. And then one thing led to another. I ended up studying law and biology.
Yep, okay. So you hedge your bets, classic right brain, left brain.
It wasn't that intentional, to be honest. It's just where I found myself.
Follow the curiosity.
Yeah. And I didn't expect it, but I actually really enjoyed law. And,
mm-hmm.
and that took me on a weird winding path. My first job out of uni was as a legislative drafter.
Oh, really?
For the Federal Office of Parliamentary Council in Australia, drafting laws for the federal parliament.
Did not know that about you.
But anyway, one thing led to another, and I found myself after a few years in some different interesting, all very interesting jobs in cross-border structured commodity finance.
Mm-hmm.
With Norton Rose, a law firm, initially in Paris for a while, and then with Standard Chartered in Singapore, and then Macquarie in Singapore. And so I had ended up doing about 15 years of cross-border emerging market structured commodity and resources work, which I really actually enjoyed and loved in a lot of ways. It was intellectually super stimulating, and you know, I like doing deals. I like getting transactions done, and that was really satisfying. But I did have, some people grow up with Catholic guilt and other things. I sort of grew up with hippie guilt, and I really had the desire to put my skill set to work in something that I felt good about. And having kids brought that to the fore quite a lot for me. I wanted to be able to talk to my kids about what I did and explain to them and be proud of that. And also, to leave a bit of a legacy. And I genuinely feel that the climate and biodiversity crises that we are facing are essentially a test of our collective intelligence. Like this is a test about whether we can respond
as a species.
Yeah. Evidence is not great at the moment, to be honest. We're not proving ourselves to be very responsive. But so that I was lucky enough to stumble really on the carbon markets. I was intentionally looking for something where I could use my skill set to do something that I felt good about.
Mm-hmm.
And I stumbled upon the carbon markets in 2017, 18. And so I'm a bit of a latecomer, compared to people like yourself who've been in the market for decades.
Yep.
But it was like an epiphany for me, because I really fundamentally believe in the market. I really believe that if we do these projects well, we can funnel very, very large, meaningful amounts of capital into projects which are actually wonderful. I mean, you hear a lot about the criticism of these projects, but if you go on the ground and see projects that are well done, the opportunity set is amazing. You can funnel money into nature, into local communities, into impoverished areas of the world. And so I really became fascinated with this idea of blending infrastructure, grade, scale and approach and execution with institutional scale capital, and try to put those together to deploy into the market.
I love that. Can we double click on that aspect? Because, upon reflection of hearing what you're saying, I completely identify with it. We spoke the other day because you were speaking at an event at NTU earlier in the week, and we were talking about how our industry tends to attract a lot of folks because they're mission aligned, right? And so it's this kind of, like you said, an epiphany around finding how the financial markets can actually now price this externality and use the force of the markets for good. But it's so now, on further reflection, you talk about projects being super impactful and great. Now, I think that so many of us that have had the privilege of going to these projects recognize that. But I will be fair. I think most of the criticism in the market that have really sort of come as headwinds over the last few years have not necessarily been critical of the projects themselves, but more so the integrity of the carbon credits that come as a result. And that's really the crux of it, because we're trading these credits as the way to generate revenue from them. But to your point, right? I don't think that up until this point in time now, there's been a clear and concise view around leveraging the financial side, marrying the capital markets at scale with institutional investors that are thinking large ticket sizes, and marrying that to nature as an asset class. But that's really where you sit, right?
Yeah, and that is the idea. So while I was at Macquarie, and I loved Macquarie, it was a great platform and is a really great company to work for. And we were looking around the world for projects and project partners to invest in and with. And there were just very, very few that we could put in front of the risk committee at Macquarie. And that was a combination of factors, but at one level, it was just a professionalization gap, a broad professionalization gap.
It's like weakness within the management.
Yeah.
Or just professionalization of how they approach the market and understood pricing risk and other more sort of mature financial kind of speak.
It's all interrelated. I think because the market historically has been small scale, it's been dominated on the ground, at least, and from an execution perspective, by NGOs and those and community organizations that have a lot of really well-intentioned, high-caliber people in them, but they have never really intersected with the institutional capital world. And so they don't understand what it takes. The way that you have to present, the sort of governance structures that are required, the level of scrutiny and diligence that capital providers are going to have to go through in order to deploy $100 million. It's a very, very different mode of operation to $2 million grant conversations, which has been, the scale at which a lot of these projects have been operating historically.
Yeah. So they're more reliant essentially on the philanthropic side. They were more akin to writing those grant type of applications.
I think that's right. Particularly in the sort of nature restoration space. I mean, obviously, you've been around for a long time, and during the CDM era, there was a whole nother segment of these sort of industrialized, industrial scale projects. But I think in this era, in the VCM era, where there's probably a heavier focus on nature and nature restoration and management. I think that is right. And so part of it is just that fundamental under-professionalization of the market. But maybe more fundamentally to our thesis is we really just mentally have to start treating these projects like infrastructure. And so that comes along with, implied in that is an idea that, well, if you step back and think about, okay, well, how's an airport, a really serious bit of equipment like an airport, a bit of infrastructure like an airport, how is that, what's the governance around it? What are the financing structures around it? What are the project planning and execution specialisms that go into delivering that sort of, or a $20 billion LNG plant? So while I was at Macquarie, I got to know one of my co-founders who was at the time the global head of major projects at KBR. So KBR is one of the world's largest EPC, engineering, procurement, construction companies. And they are the guys that will actually deliver mega projects, the 20 billion range sort of CapEx projects. And
across what sort of areas? Like, you're talking infrastructure, you're talking dams, like bridges.
Bridges.
Airports.
I mean, KBR has a broad, very broad practice. Mark's background is really energy, so $20 billion LNG projects and that sort of project. Very high levels of complexity. You might have 10,000 people on site. So they're a real machine. And I think
that's a level of expertise in project management that is it's 2 orders of magnitude greater than anything that's happening in the carbon markets today.
That's right. And I think what we as a collective industry have sort of overlooked is that is a specialism. And it's a really deep and important specialism. There is a body of knowledge out there in the world that has grown up over the last century on how you do very large projects. And one of the key sort of strategies for our business is lateral importation of that know-how and then right-sizing it and combining it with carbon knowledge and cross-border emerging market structured finance knowledge to put that together to deliver large-scale projects. So that really is a big part of what we are trying to do. My other co-founder, Jake Howard, has about 20 years of cross-border emerging market legal resources work behind him. And he and I went to university together. We've known each other for a long time, and we've done a lot of business together over the years. But again, it's that trying to combine the major projects expertise, the carbon and commodities expertise, and the legal and structuring expertise with technical carbon, which we have under our Chief Carbon Officer, to see, okay, well, how do we deliver infrastructure grade and infrastructure quality projects?
It's fascinating. And then, so in terms of, just for contextualizing for the audience, when you're thinking about this kind of infrastructure scale and type of play and marrying the finance piece with large capital markets and institutional investors, where's your focus at Imperative today? It's fair to say it's on nature-based removals, but can you quantify that for us and kind of give us examples around where you guys are focused?
Yeah. I would start by saying philosophically, we believe in an and approach. One of the things that we're not very good at in this market is supporting people in other niches in the market.
Yep.
We are very firmly of the view that we need all of the solutions at hand. This is how heavy CO2 is, greenhouse gas is. We're pumping 50 billion tons of that per year into the atmosphere.
Yeah.
It is a colossal problem. So this idea that we should be partitioning between different solutions is, for me, a complete nonsense. We started off with a removals and avoidance strategy because we believe in both. And we particularly believe, for example, in the context of nature, that conservation is inherently valuable. It's one of the lowest cost of abatement tools available to us. And it also happens to have the highest biodiversity opportunity. It's great to replant and restore ecosystems, and I'll come to that in a second because that's what we are doing. But you can't restore lost biodiversity, or if it's extinct, it's gone, and it does take a very, very long time to restore lost biodiversity. So we start off with a removals and avoidance strategy, which is also coincidentally very important from a sort of cash flow perspective for businesses like ours, because avoidance projects create tons earlier than removals projects do, and so
more backdated.
Exactly.
Yeah.
And so there is a, strategically from a portfolio design perspective, you also need both in an ideal world. Having said that, what we've seen in the last few years since inception of the company is this flight to quality. And rightly or wrongly, and I think in some part at least wrongly, that has been read by the market as a flight to removals. But what that means for us is what was previously a portion of our portfolio has now become our primary focus. And so our primary focus in our portfolio, in fact, our only focus for the moment, is 2 project types: native species ecosystem restoration projects, terrestrial AAR projects, and mangrove restoration. And we will come back to other project types as we build out the portfolio and as the market matures a little bit. But for the time being, that's really what we're focused on.
Yeah, so just picking up from that, you're talking about this and approach, right? Of ecosystem restoration, native species reforestation, but also the avoidance.
Yeah.
And where I was alluding to was essentially, it seems that your focus now is more concentrated on the ecosystem restoration piece. Is that because the capital allocators, the investors that have now funded into your projects, they're looking for that? And is that a response to the demand signal on the buy side that has necessarily shifted towards a preference for removals? Is that a fair assumption?
Yep. I mean, that's basically it. And the interrelated topic of quality, our goal is to be in the top 10% of quality in the world.
Yep.
For tons that we produce. And as you know better than most, there hasn't been a lot of consensus around quality to date. I mean, that's changed over the last few years, and I think we are getting more and more consensus about what does that actually mean. But we're trying to help to define that, and not in a narrow MRV sense, but actually in a broader sense which includes things like project operations. How do we actually ensure that we're operating these projects extremely well to the level of the sort of standard of governance and discipline that would be applied to another asset class in a more mature physical asset market. So that those 2 things of wanting to really demonstrate high quality, because we think that helps to unlock the market, really, is to show that these projects can be done well, is one. And then the second interrelated one is where the market is. The people writing long-term offtakes are writing long-term offtakes for nature-based removals, and people deploying capital at the moment at scale are people deploying capital into removals projects. So I don't necessarily philosophically agree that should be the case, but
that's the playbook, right? That's the lay of the land.
That's where we are.
Yeah.
And that will hopefully change over time, but for the time being, that's our focus.
Cool. Can I just double click on not just the flight to quality of the underlying units, right, that emerge from the project, but the quality of the project developer itself. Because you touched on it, right, around the professionalization of essentially the project developer, right, strong management expertise, capability, but thinking large scale and thinking at infrastructure grade, right, and the execution component. They're to me like areas that are not only controlled at the project developer, but are super important for the institutional capital to want to come in and write these big $100 million checks. So can you give me just kind of an example? You touched on some of your partners' background, but what does that look like on the ground? Because how many people are going to end up having to be deployed? You mentioned like an LNG project with maybe 10, 20,000 people. For the type of carbon projects that you're talking about, which is your reforestation and restoration of an entire ecosystem, that's very ambitious. You're breaking this kind of mental boundary of the 5 to 10,000 hectares and now going into much, much larger projects. That takes a different skill set.
Yeah, I would be lying if I said it was easy, but thankfully we do have people in the business that come from that background, and so we have people that specialize in project controls. Okay, what's project controls? Project controls is a specialism which looks at how do you actually accurately cost forecast, schedule, and risk manage in major project execution. And that is very, very sophisticated, very detailed costing, scheduling, and the ability to control ripple effects if things change in the project. So again, it's an overlooked skill set in the carbon markets. It's a skill set that is viewed as essential in other major projects, mega project classes. On the ground, our thesis and belief is that the carbon market historically, and the voluntary carbon market particularly, has relied on implementation partners.
Yeah.
And for us, that's a bit of a dirty word because what it implies is abdication of control in large part. And that's one of the drivers of quality problems that have historically plagued the market. So
it's a classic supply chain issue, right? You think about, in apparel, there's brands and then they sub it out to subcontractors. It's similar sort of parallel, but like you said, unless you've got really strong quality assurance and quality control, then you abdicate that control. That doesn't really speak that well for this flight towards the quality, right? That's the bottom 90th, decile, right?
Yeah, apparel, like manufacturing, an example. In other major project categories, what you would have is you have an ecosystem of contractors that are capable that have a balance sheet, that have a mature governance structure, that have mature management, and that you can actually reliably contract to deliver parts of a project.
Yeah.
That doesn't really exist here, particularly in the ecosystem restoration subsegment. This is a new sector, and you can't just go and find a contractor on the ground that can roll out the project for you. So we've in-housed that. All of our projects live in a subsidiary that roll up that are controlled by us and roll up into our corporate structure.
And Topco and then project SPV.
Yep. And then we staff those project SPVs with and budget to have 40-year operating capacity with professionals with multi-decade experience that are capable of delivering on a major project. And that's a combination of major projects experience, ecosystem restoration experience, nursery operations experience, community.
Emerging markets, as you mentioned, because this is in the global south where these project activities will actually take place.
Yeah.
Right?
So again, if you look at if you take the learnings from what's been done in other asset classes, you will have a combination of local talent and imported talent sitting together in those project vehicles to ensure that the projects are done to the global level of quality that's required, but with an understanding and appreciation of the local context.
Yeah.
And that's, for us, the operating model. The operation of that vehicle, we staff the vehicle with all of the expertise required to deliver on a 40-year project, and contractually we have 100-year contractual rights in relation to the project area. So we're staffing that vehicle to deliver. If you think about, again, the way other asset people in this market tend to talk about project implementation. Okay, in the case of the sorts of projects we're doing, that's your planting phase. But then you have asset management and optimization. So let's say the planting takes you the first 5 years. You've got a 35-year asset management and optimization. And the quality of the tons that you get out of any of these projects is not a function of what you do in the first 5 years. Tons are issued every year or whenever you choose to issue the tons. So you have to optimize these assets and ensure that they continue to perform, just like you would in any other more mature asset class. And so the philosophy that we take in designing the local teams and staffing them with senior people with a composite of the skill sets that we need is to make sure that we have the team not only to oversee the nursery setup and supply chain and planting, but then the asset management and optimization so that we continue to get high quality outcomes and high quality carbon for the duration of the asset life.
And that life, you mentioned 40 years and then another 60 on top for the entire of the life of that project.
Yeah,
I mean,
so
that's a really long.
It is a very long
time,
and
yeah.
you know that sort of this idea of 100-year permanence has really flown, I think, largely from the Californian market, and it's sort of been pushed out into the voluntary market. It's a pretty long time for emerging market project to have 100-year permanence, but we are seeking to achieve that. And in South Africa, in our major project in South Africa, that's exactly what we have. We have 40-year leases over the land and then 60-year servitudes, which are registrable instruments over the land title that prevent anyone from doing anything that would result in a backtracking of the project or affect the project. So yeah, we are aiming for 100-year lifespans on these projects as one of the hallmarks of quality.
Right. So Scobie, just wanted to pick up on something that we were just talking about earlier. Specifically, you mentioned risk. And I really want to do a deep dive on a couple of areas of risk, if you'll indulge me. But let's begin with project level risk. Because you're talking about infrastructure scale projects, these ecosystem restoration projects, and looking at this execution capability and actual deployment of capital and all of that component. But there's a risk lens you mentioned around your time at Macquarie, evaluating a number of projects that just couldn't make it to financial investment decision and all the risk teams. What are you doing at the risk level that differentiates Imperative from the rest of the pack?
Yeah, I mean, risk is a defining characteristic of this market more so than other markets, I think. And there's a variety of risks that are relevant and top of mind. One of the most difficult to deal with, I suppose, in this market is reputational risk.
Yep.
And that is the sort of pernicious one that is hard to quantify and hard to quarantine. But at the end of the day, that reputational risk can be broken out into component parts. And the way we think about that is, at a fundamental level, is the project doing what it's claiming to be doing on the ground? And if you follow the vein of our thesis, at least, how you ensure that is the case is you take the execution extremely seriously. So you execute on the projects the same way you would execute on any other infrastructure project. And so what that means is, so we have a risk and opportunity matrix approach, which is again lifted from the mega projects world, where you will have a risk registry of all the risks that are relevant for a project. And we've taken time to take that body of knowledge and integrate the risks that are relevant for these projects and been informed by evolving things like ratings agencies and other quality standards, you know, Microsoft Carbon Direct, AAR quality standards, for example, and other input sources, to derive a risk registry that's specific and relevant to what we're doing. And then we go through a process of identifying the risks, working out how we're going to mitigate the risks, and for risks that remain high probability or high impact post-mitigation, we have a preordained risk response plan that is actually a written plan that says how we're going to go about responding to that risk should it arise. And wouldn't claim to say we've got everything nailed down perfectly, but that's by going through that process, we feel like we are again bringing this sort of major projects approach to, okay, people have been executing very large projects for a long time, and there is a body of knowledge around about how you go about methodically structuring your approach to risk identification, mitigation, and management, and we're trying to deliver that on the ground.
Yeah, and that's a very mature market type of approach that we're now applying to carbon markets. I like how you sort of talked about before around, new entrants coming in. And this market should be welcoming of the infrastructure folks, capital markets folks, and different people that have got experience that could be applicable to our market. I like how you framed it around preparation, right? Because you've identified all these projects in this risk matrix, and effectively now can mitigate those that can be mitigated, and then where there is a risk of this occurrence, you have a ready response plan. One of the things, however, that we haven't talked about is, thanks for unpacking effectively the project level risk side. I think it's a very mature approach, but it's the pricing of risk. So it seems to me that this level of approach of understanding and mitigating risk and planning for eventualities attracts a level of sophisticated investor, right? But let's talk about the risks that are not being currently priced in the market. And that's the risk of inaction. Can you unpack that for me and for our audience?
Yeah, this is a bit of a passionate topic for me, but I came from institutional investment side of the equation where regulated financial institutions like Macquarie have one of their key metrics is return on regulatory capital. So they have, for a given type of transaction, there is a regulatory framework that dictates the amount of regulatory capital that needs to be held for that financial transaction, and that is a function of the perceived assessed risk in the transaction.
Yeah.
But what we, and maybe just to take a step back for a second, in the context of native species ecosystem restoration projects, they are popular projects. They are in demand, both from buyers and investors. They're also very hard to make work economically because native species regrow slowly. And you have a big capital outlay at the beginning for nursery infrastructure and supply chain build out and planting and all the labor and equipment and everything that's required for that. And the repayment of that happens over a very long time. In some cases, production doesn't peak until year 10 or 12 or even 15, depending on the type of ecosystem that you're restoring. And so we have a challenge of making the returns work on these deals because they are very long dated cash flows. Even if buyers are willing to pay a premium for high quality projects, high quality credits, it still can be quite hard to make the returns work because of the cash flow profile. But what we really see in the market is that when people are doing their return on regulatory capital or other similar equivalent assessments, the risk of inaction is still not being priced in. So if we think back around why are we in this predicament, it's largely because we've allowed ourselves collectively to pollute without pricing that externality into the global economic system. It's been allowed to just persist outside.
Polluting for free. Yeah.
And in the same way, I think we are still failing to price in the risk of climate inaction. So you can go and look up the statistics, but it's trillions and trillions and trillions of dollars at risk if we don't do something to address climate and biodiversity. We're heading towards a brick wall, and it will, there's something like 55% of the global economy is directly at risk or has nature-related risks associated with it from a supply chain perspective.
Yep.
We're talking about massive climatic and biodiversity-related risks. But at the moment, from a capital allocator perspective, that risk of inaction, the future risk of deleterious effects on their investment portfolio, is not being priced in to their risk models. And so we're getting this artificially imbalanced risk return assessment, which is skewing us collectively away from deployment of capital into projects. Because
at a critical time.
At a critical
where
time.
time is evaporating really, really quickly.
Yeah. So we all know you've got to price country risk, and you've got to price market risk, and we've got to price operational risk, and all these other things that we're used to pricing. But the other side of the equation, the risk of not doing anything is
not
still
being adequately priced.
Yeah, and so that's distorting risk and capital allocation decisions, in my view, globally, and it's something we need to find a way to address.
But I think we begin to address it by having the honest conversation about the fact that it's there, right?
Yep.
But then how, like, what's the hope here in terms of the dialogue that we're having now, and how do you think that we can help to shape the response, right? You talked about having a risk and a ready response, like action plan. How can capital allocators start to really recognize firstly the risk and then respond to it?
Yeah, it's a great question. I mean, I think this market, we do a lot of talking, way too much talking and way little action.
Yeah.
At the end of the day, if we crystallize externalities onto the balance sheet of actors globally, so what I mean, just crystallize your emissions liabilities as liabilities on your balance sheet, crystallize your nature exposure as a risk exposure, somewhere in the way that the business is being operated.
Yep.
Have that. All of a sudden, we crystallize this risk so that when lenders are looking at companies, they are seeing this risk and they're taking that risk into account, because most companies, 75% of the emissions in the world are still not priced. That means, simplifying a bit, on average, companies out there have 75% of their emissions liabilities that are not showing up anywhere. There's a massive body of unpriced risk, and that's not even talking about nature and biodiversity risk, just emissions, just emissions risk. If we get those risks out in the open and get them on ledgers and balance sheets and in reporting, all of a sudden capital allocators have to pay attention to them. They can't be ignored. And then you start getting a rebalancing, because as a capital allocator, then if I'm investing in a company, I should necessarily be saying, how are you hedging that forward climate risk that you've got?
Yep.
Just like I'm asking, how are you hedging your long-term FX, or how are you hedging your supply costs? These are all questions that are being asked. We're not asking the long-term climate hedging question because it's not appearing on the balance sheet.
Yeah.
We've got to correct that. And as soon as we correct that, we'll see an adjustment in this, a correction, in my view, in this risk return assessment.
So Scobie, just want to kind of bring it, still on the risk lens. So we've addressed project level risk and the structure around the matrix there. And then you talked about that really interesting view around not pricing the risk of inaction. But I want to kind of bring it back into the kind of the universe of the projects themselves. Let's look at it from the buyer's perspective. What are the other risks that essentially can be what are the risk instruments essentially that are out there is the question that are happening in this market. And I think we talked about it yesterday over lunch, briefly around the insurance side of things. Can you unpack that for us in the audience?
Yeah, I'd say there are, obviously oversimplifying a little bit, but there are, other than reputational risk, there are two other risks that I really see as being sort of defining threshold risks that are maybe preventing more people coming into the market at the moment and or occupying people's time. So one is delivery risk, and this goes a little bit to the absence of genuine large-scale execution capabilities in the market, because it's easier to sign a long-term offtake contract and you won't know that there's a problem until the tons don't show up in 5 years or 6 years or 8 years. So I think that people are becoming more aware of this as an issue and realizing that it's not as simple as doing day one diligence. You've got planting risk and then a whole lot of other risks that may intercede to delay or affect delivery of the tons. So one of the things that we've been working on, and actually we just formally launched in partnership with Kita, is a developer-led general non-delivery insurance product.
Okay.
So that investors in our projects or buyers from our projects can come and elect to have insurance-wrapped tons. So it comes at a cost, and we're transparent with that cost, but that comes with a general non-delivery wrap, so that a buyer has a wrap should anything affect the delivery of the tons in the future, and same for an investor. And it's we took quite a while to work through it, and Kita were a great partner to work with. But I'm quite happy with the product because it is a pretty general, broad risk coverage. And so for those buyers that have certain commitments that they're trying to live up to, this is a really important tool. And we are seeing that delivery risk becoming more and more of it in focus as the market matures. So the second risk that I think is occupying headspace at the moment in the market is commodity price risk. That's sort of an obvious thing to say, but when we think about the ability to get financing for these ecosystem restoration projects, you need long-term offtake contracts to underwrite them at the moment, and there are only a small set of buyers in the market that are out there writing 15, 20-year contracts sufficient to underwrite these projects. Absent those and outside of that small subset, projects are being funded by a small group of specialized capital providers that have directional price risk appetite on carbon price. They're able to invest in merchant risk projects that don't have an offtake contract in place necessarily.
That's a very small group of very specialized investors, right?
It is. And so, and we have the privilege of working with some of them. But if collectively we want to scale the market and crowd in more traditional capital at scale, we really need to work out how to manage that commodity price risk, because most traditional capital providers just do not have that directional carbon price risk appetite. They want a debt-like product. So they don't want carbon tons, they don't want carbon price risk exposure. They want a predictable cash flow from a sale of carbon from the project. So that can be done in two ways. It can be done in long-term offtake contracts, or hopefully over time it can be done via a maturing of the derivatives market around this sector, so that project developers and or investors and or buyers can hedge that risk in the
price
market.
Risk. Yeah, and we saw obviously a prelude to this, right? And when we were working together, you were at Macquarie and I was at Expansive. when our team wrote the contract specs for the geo and specifically the NGO contract, it was that perfect moment where the market really needed that pricing risk hedge, essentially.
Yeah.
So it seemed to me like there's an opportune time for the next evolution of futures contract standardization in this market to emerge, specifically around the ecosystem restoration component. And then do you think that having that, coupling that with the offtake piece that helps to de-risk these project developers and that small quotient of investors that are risk on, essentially, we can now kind of kickstart that flywheel to really unlock these opportunities at scale?
I very much hope so. Hats off to some of the big tech players that are out there writing long-term offtakes, and I think helping to really demonstrate what that looks like and showing thought leadership.
They're playing a really catalytic role in this market, especially coming in at the time that they have, and they've ramped up. We're talking tens of billions of dollars of investment across the forward curve.
Yeah.
Right? But there's an inelasticity in this market, right? In terms of the response timeframes. These projects, like you said, are infrastructure-like, right?
Yeah.
That need to occur at scale. And if not, it's going to be very small projects that are piecemeal together. The due diligence process alone, it's kind of counterintuitive. You need to have these big projects because the due diligence takes so long. And, like, they're playing such a catalytic role right now, but we need to encourage other participants to come in.
100%.
Right? And we need to reduce that barrier of entry. So it seems to me like all of these different ingredients play a key role.
Yeah. I mean, if we can work out how to mature the derivative side of the market, work out how to crowd in other long-term buyers, that's going to be really essential to create an environment where we can get more traditional debt in and really scale.
Yeah. Do you mind if you indulge me just for a second, a bit of a side quest here, if you will. But as we're talking about this, it comes to my mind, the topic of the conversation that you had at NTU. You were on a fireside conversation you presented earlier in the week. And you were talking about nature as an asset class, and you had a really interesting slide where you're talking about effectively this pricing differential that occurs in the market from, let's say, the more traditional monoculture reforestation to the native species side of things. And you were talking about effectively a basis spread to the upside, right? So kind of you piqued my interest because of this, talking about a hedging instrument. If we look in the future and we had a hedging instrument for ecosystem restoration, do you think that now creates a mark that trades at a significant premium that's reflective of, let's say, biodiversity impacts? Because, like you said, if we lose biodiversity and we don't remove or reduce carbon, we're heading towards a brick wall. How do you see it?
Yeah, I mean, I think this is a fascinating topic and a really important one. Again, this market is just quite an immature market in a lot of ways, and we've got a lot to learn. And I think with a bit of intention, we could learn quite quickly by importing know-how from adjacent industries. But as you know, so if I think this is quite an interesting analysis to do. If you look at, we use Trove MSCI forward curves, and if you look at those published forward curves at about, I'm rounding, but if in 2040, the commercial AAR, which is your monoculture timber projects that are also generating carbon, are trading somewhere around the $60 mark on that forward curve. The native species ecosystem restoration that MSCI calls conservation AAR is trading at about $114. So you've got almost 100% price differential. There's a very big spread there. Now, that is basically the market pricing in biodiversity, nature co-benefits over and above the carbon outcome.
Correct. But also, would you not say also like the difficulty of scaling those projects? Because there's also a supply-demand quotient, right? There's a lot more demand, and you just intimated how difficult these projects are to do at scale. There's also a supply component, right?
Absolutely right.
Scarcity.
Absolutely right. So the trick, I suppose, the complexity is for us to break down that spread and work out what's attributable to what component part. But I really do think that I do worry a bit about biodiversity markets as a standalone market, because I think we can distract ourselves. Personally, I really think we should be thinking, I mean, people will argue, well, carbon can't be used for all biodiversity projects, and I'm sure that's probably true, but there is a very large number of projects where both of those things necessarily interrelate and overlap. And I think to the maximum extent possible, we need to be getting carbon projects done and then attracting a positive differential for biodiversity outcomes. We are trying to produce ultra high quality carbon credits, so the top 10% of quality in the market. And what that means essentially is trying to restore ecosystems to what they would have been in their natural state, including all of the biodiversity and other ecosystem services and co-benefits that go along with that.
Yeah. And obviously, like you said, it's going to be difficult to pass that out. But I subscribe to your thesis as well. Like, I'm very supportive of it, the genesis of these biodiversity markets, but they're highly localized. What they lack, which carbon has, is that we've got this one ubiquitous atmosphere. And so carbon emitted in one location is equivalent to any other location. And so we share that atmosphere. The biodiversity impacts occur at such a localized level. It's fairly difficult to create a global market and market pricing for biodiversity since it's so localized, right? And so I think having that stapling on to the carbon component, certainly you can create the infrastructure and the governance, let's just say more accurately, around the measurement of those biodiversity impacts. That I'm all for. But if they're bundled, just kind of like what Vera used to do, and it has done with Vera, like the VCS plus the CCB component, that created a differential to the upside for those projects. And then you started to see like you said earlier, this shift towards or flight towards quality. Yeah, I think we just see that continuing in this market.
I totally agree. I mean, and again, if you look at, people in this market will hate this as an analogy, but if you look at crude or some sort of other very well established commodity market,
these are highly liquid, very important markets that are critical for the life's blood of our economies. We should be learning from them.
We have to learn from them, and if you look at them and we do learn from them, you'll see, you have indexes and price markers, and then you have geographical and quality-based spreads to those markets. And I tend to agree with you. I think that we absolutely need premiums to be paid for biodiversity outcomes, but that doesn't mean we need to try to artificially create a unitary tradable ton of biodiversity. It should be thought about like a quality diff to the carbon outcome.
Agree. Cool. Scobie, we've covered a lot. This has been a wide-ranging and incredibly interesting conversation. Can you give us, I always like to end these conversations on a hopeful note. Let's just touch base around the sort of mission alignment of this industry. Can you give us, sort of hopeful sort of conclusion here in terms of your mission and what you're hoping to achieve over the next 10, 20, 30, 40 years?
Yeah. So we have a vision of being the world's leading nature infrastructure business. And in striving for that, helping to create nature as a genuinely investable asset class with triple bottom line benefits for climate, biodiversity, and communities. So that's our personal sort of company corporate vision. What excites me and is, again, we know how to do this. We know how to do large projects. We've done them in other contexts. This knowledge doesn't exist off the shelf, but it exists in different parts and it has to be fused together. But all of the noise in the market around quality, it's just about doing it well. So at one level, the thing that inspires me and makes me hopeful is it's not that complicated. On the ground, it's hard work. Emerging market projects in any industry are hard work. In these sort of new frontier markets where you're doing mixed native species that haven't got a lot of science behind them, it's hard work, but we have solutions. I also am just really inspired because I see a lot of low-hanging fruit around the lateral importation of know-how from other industries.
Mm-hmm.
And as the market scales and we crowd in more and more talent from adjacent industries, I think we can accelerate the pace of learning and therefore the pace at which we are able to deliver the solution. So I am hopeful. I'm personally, from my own personal journey, I'm really enthralled by this idea of how do we take all this learning from other more mature segments and do these really high quality projects. Like, how do we actually deliver that? And we're learning along the way. I mean, it's we'll inevitably not get it right all the time, but we think we're on the right path. And there are other people in the market also pushing in that direction. And I think we have the ability collectively, if we put our intent behind it, to really do something meaningful where over the next decade we create genuine institutional investability for nature as an asset class and a genuinely thriving global carbon market.
What a great end. Thank you very much, Scobie. Really appreciate the conversation, mate, and wish you and your team continued success. I'm really excited to see the continuous involvement of evolution, I should say, of your projects. Thanks again for joining me on the show.
Likewise. Thanks for having me.
Thanks, mate. Bye. Cheers.